This is the current federal tax developments for the week of August the 11th, 2025. Current federal tax developments are brought to you by your state society of CPAs. And we're going to talk a little bit this week about developments coming up. I'm Ed Zollers. I am recording this. I am back in Phoenix. I was up in Flagstaff on Friday, giving an in-person ethics session to the chapter up there. So had a little fun on the way and a little bit cooler. Did stay over Friday night to take advantage of a nice cool morning because you don't get those in Phoenix this time of year. But I did come back down and I'm going to record this now, obviously, before we get started with this week's stuff going on. So, big development that we had on Friday that I'm going to talk about before we get to the real standard stuff we normally do is the commissioner of the IRS, Billy Long, has left his position. Not quite clear all the details of how, why, and etc. He has stated that he will be appointed or expects to be appointed ambassador to Ireland. It seems a little, interesting because this will be. We've had a lot of commissioners or acting commissioners since the start of the year. The Treasury Secretary will fill in as acting commissioner in the interim until another commissioner is appointed, and will go and fill that seat. So we'll see what's going on. A couple of other things that involved basically Commissioner Long. You may remember we talked a couple of weeks ago about how Commissioner Long had said that the new tax season would not start until after President's Day in 2026. Well, the IRS issued an announcement this week, and it became interesting that it came out. We started getting hear about these emails, and we started getting other announcements that indicated, well, we haven't really decided on a date yet, and that's still pending, and kind of walking back that date. And even Commissioner Long attempted to say on Thursday, remember the next day he's out of the office, he's going to be out. We expect it to start on time. So not sure what that was all about. Not sure if something, that was something he shouldn't have said, what he was doing, etc. But in any event, Billy is no longer the commissioner. So we will have an interim. Being the Treasury Secretary, will pull double duty in the interim. And we'll see who the new commissioner will be. But that is new. And also means that we're back to, we don't know when the tax season is going to start. Because we're now back to, we should be able to make it on the regular date. We'll see. I mean, all of this is a we'll see. We'll find out. We find out, which is probably where we were before anyway, but still, that's where we're at. So aside from the fact that we will have a new commissioner, let's go ahead and take a look at what else we discovered this week. First, the AICPA sent a request for urgent guidance on certain Section 174 Cap A domestic research and experimental expenditure issues from part of the OBBBA. So we'll have to discuss that. We're going to talk about post-referral authority in tax litigation. That seems like a weird term. What really happens here, though, is what happens if you sue the IRS, which this taxpayer did. You filed your claim for refund for the ERC. The IRS has been sitting on this claim for an extended period of time. You go ahead, you file your petition with the U.S. District Court, because after 6 months you have a right to do so. You start doing that, it gets referred to Justice Department to handle the case. But then out of the blue, the IRS sends you a notice saying they've approved the refund. Did you just win? Or maybe not. So we'll talk about that here today in this case. We'll also talk about yet another microcaptive, but this one's interesting. Microcaptive loss for taxpayers, because this taxpayer got way closer to winning, or at least covering their bases on most issues. There was one key area that fouled up and they lost, but it's interesting that it did get closer. So it may provide at least some of a roadmap about what you would need to do to have a micro-captive structure work. If you're not huge, the Rent-A-Center case obviously worked, but again, most companies aren't going to be able to pull that off with, captive carriers. You're not as big. So we'll talk a little bit about what that told us. I'll talk about some proposed amendments to IRC Section 132 Fringe Benefit Rules. It's mainly just updating the references they're using, but we'll talk a little bit about that because there are some other changes they're talking about in there. I want to talk about what happens if you are an S corporation. It files for bankruptcy, but it has pass-through losses incurred. In essence, does that mean that the losses can't pass out to the shareholder? And that was a question being raised basically due to a claim for refund being filed with the IRS regarding a loss from an S corporation. And we'll talk about how the chief counsel's office resolved that in field attorney advice, but primarily resolved it by indicating that, well, there was a basic problem that we had with this before we even get to the bankruptcy, but also why the bankruptcy didn't really affect it. And so we'll get into that background as well. We have a note that came out this week, an alert from the Office of Professional Responsibility discussing the potential for proactive engagement with OPR when you have a problem. Now, I will warn you before we get there, it's obviously written from the perspective of the enforcing agency. And an enforcing agency will always believe it is best for you to come forward. But we will talk about why that is a consideration. Largely because that is part of the plan, not though that you necessarily just blindly follow what OPR says here and not consult counsel before doing so. Make that caveat big. And finally, we're going to talk about a policy announcement that came out on the One Big Beautiful Bill Act regarding 2025 payroll issues. For the rest of this year, that would cover things that obviously impact payroll, like the tax on no tax on tips provision, and the overtime provision, because one of the requirements of those bills will eventually be to have qualified tips and qualified overtime identified on W-2s. Plus, there's also the requirement there that essentially the withholding tables be updated. Well, as we'll discover, the IRS is going to tell us we're not going to do all that till next year, which is technically what the bill required anyway, but we'll get there. Okay, let's go to the AICPA's urgent guidance request on domestic research and experimental expenditures under new IRC Section 174 Cap A. Okay. This is a letter entitled Small Business Taxpayer Domestic Research and Experimental Expenditures and the Election for Retroactive Effective Dates of Section 174A. The letter came from the AICPA's Tax Executive Committee, and it was dated July the 31st, 2025. Now, what happens here is the AICPA has formally requested immediate guidance from the Treasury and IRS regarding Section 174 Cap A, domestic research and experimental expenditures, domestic R&E costs, with regard to certain issues. Now, this is really important because a lot of companies now are facing questions about what they're going to do as they try to finalize their 2024 federal income tax return that's on extension, when now we know that they would qualify potentially for the election to amend 24 and 20, and 22 and 23, and claim essentially those amounts that are being set up and amortized, and claim them as if they've been fully expensed in each of those years. And the problem is, what do we do going forward? Because the bill itself, basically is worded oddly about how we're going to deal with this. And the key thing to look at here, if you want to go trace what they're talking about, go look at section 70302 of essentially, basically the act, right? Which would be the OBBBA, right? Which generally allows immediate expensing of section 174 Cap A costs for tax years beginning after December 31st, 2024. But our real issue here is that special rule that lets us go back and recover. Those costs have been previously expended. So if you don't remember that one, that is a provision that is not added to the code, but is in the act itself. So it's one of those things they don't put in the code, but it is a transition rule that's in there. And it would allow eligible small businesses, generally tested under $30 million of annual revenue test for average for the 3 prior years to 2025, if they're an eligible small business, they could elect to essentially substitute December 31st, 2021 for December 31st, 2024 for the effective date, which would grant retroactive immediate expensing. But it's not just worded that way. The The problem is under the statute as worded, under the bill that we have, not the statute, because it doesn't go into statutes. It just goes into the, basically the session law, shall we call it, for this session of Congress. You're allowed to make an election to, take advantage of this, move this back, right? And that election allows you to say, that, and according to the transition rule that we have in that section of the bill, you are allowed to then amend returns for years, beginning before December 31st, 2020, or before December 31st, let's say before January 1st of 25, reword that properly. So 22, 23, 24, in order to claim it as if we were allowed to expense domestic R&E in each of those years. But the problem is making the election as stated would appear to bind the taxpayers to amending returns. And that's unique. Now, the AICPA reads it as saying, well, the only alternative would appear to be, and I'm not still sure this works, but I guess we might argue it does, that you might have to make an election to cover the first 2 years, but you couldn't just expense the amounts on your 24 return that you've not yet filed, unless you filed a request for a change in accounting method. And the real quirk about that is there's nothing saying that such an election would be granted automatically. That change in method of election, it's not an automatic change. So the problem is, if you did it, you'd need IRS permission, which you're not going to get by the extended due date. So the issue that a lot of people are facing is, do we have to complete the 24 return, go ahead and capitalize those expenditures for domestic research and experimental expenditures that we know are going to go back and amend and just, we're going to go back and make the election. And we know that, and we haven't filed the return yet, but do we still have to capitalize them and pay tax based on as if those have been capitalized, and then just like immediately turn around and amend the return and make the election? Now, by the way, the form of the election has not yet been given either. I think it's likely, but not certain, that the courts would find this part of the law self-executing, that even though the IRS is told to set up, tell us what we need to do in this election, the court would see that as basically just a simple administrative function and wouldn't necessarily, if a taxpayer took reasonable steps to give information that it would appear the IRS would need to process this, would keep them from making that election. But again, the problem is, but it literally says you must amend the return, and that's the only way this election works. So AICPA says, IRS, are you really going to want us to go down that path? Is that how you're going to do this? So they're saying, IRS, you should issue guidance that states eligible taxpayer who deducts 2024 domestic R&E costs on their 2024 federal income tax return and includes a statement or reference indicating their election has been made will be deemed to have made a valid election. Now, obviously, as the AICPA notes, this is all contingent on being otherwise eligible and complying with all the other rules, including those in 280 Cap C little c about, deducting expenses, and research credit issues and things like that. So you got to qualify with all that stuff. So they're saying, so they want flexibility for retroactive application. They're asking for. They want the IRS to affirm a taxpayer may either amend their 22 and 23 tax returns or file a change in method of accounting for their first taxable year beginning after December 31st, 2024, right? And going down that path. And also, if an eligible taxpayer makes the election as an NOL for any affected year, they should be permitted to adjust the NOL in the carry forward years with a notation in lieu of amending the NOL year return. That is, if it doesn't change anything, can we just adjust and make notes? Or even if this is now going to make no difference, right? They're going to get nothing. We're just changing a carryover. Are we still have to file an amended return? Because, as I said, the law basically states you have to amend. So why the IRS wants to say, first thing is, look, it's ridiculous, guys. We're trying to allow them to avoid unintended consequences if they deduct their domestic, research and experimental costs on original 24 returns because a lot of people probably just going ahead and doing that. They've read, they heard they're eligible to do it. It seems crazy, right? No, we're not going to do that. Now, I've been telling everybody, that asked me about it, that officially you have to, if you take the law literally, which, by the way, our courts tend to do, that you would have to file the return, amortize those expenses. Then once that dust settles, then go ahead and make your election and then file 3 amended returns. That's what the law says you have to do. But it's ridiculous. IRS, just use your discretion. Congress is not really going to yell at you for this. And I can't imagine who would have standing to go to court to challenge it. Because that's the practical issue. Even though it's very likely a court wouldn't allow it, if challenged, they would first need to have a case where the person bringing the issue would have standing. And it's difficult to figure out how they have standing when they'd have a remedy. The only people that would be impacted are those that could file the return, that are filing a return and claim the refund. The only party be impacted by it would be them, and they can just not do it. No, they're not required to. So again, IRS could probably do this with no negatives. And yes, I know that drives more than a few people batty and bothers me a little bit too, that apparently you can kind of ignore rules as long as, when you get that situation where nobody would have recourse in court. But again, we get to the whole standing question, which the courts, they've tried to address that now some cases, but it's really weird. So we'll get there. Okay. It says what they want to do is they want to say provide timely guidance to allow them to deduct 2024 costs and preserve the ability to deduct 22 and 23, because that's the other concern. If I say I want to change my accounting method effective January 1st of 24, even assuming I get that, have I now said, well, that's the date? And I couldn't go back and make this election because I can no longer make an election for all 3 years. So we need this done. It would benefit sound tax administration and get rid of uncertainty for everybody, get rid of unnecessary work for everybody. So saying, guys, you should do this. And the problem is, it would provide immediate tax relief to taxpayers who Congress intended to do that, right? And also provides relief to those who may have inadvertently deducted 2024 costs and they fear jeopardizing their ability to go retroactive. What's happened here is some people, they read about that in the law. By the way, it's always dangerous to act too quickly on a new law until you verify it independently. Gang, hint. Initial analyses of the law, even coming from very reputable sources, often don't get everything right, or more importantly, they're trying to please an editor who thinks that what they're saying is too complicated, or messy, and it goes on too much, it's too much in the weeds, nobody will read this. They simplify it. And there is a huge danger when you are simplifying the analysis of a new law. And unfortunately, editors may be editing for clarity, but they're not technical editors. Yeah, we can get situations where that causes problems. It's made it simpler. It's made it easier to, quote, understand, but it's also skipped over a very important point that could come back to bite you because the courts don't summarize and simplify. The courts are going to apply the actual law. The IRS will apply that law. And here's the flip side. If the IRS doesn't do this and they decide to play hardball on this one, you have to do it exactly the way the law says. I don't think the courts have an option here to easily, grant relief. Again, you would be going against a statute, not a regulation. That's a huge problem. The statute requires you to do this, or I should say, the text of the bill, as passed, enacted into law. So the act requires you to do it this way. So that's why we hope to see some guidance, why the ASPA is pointing for this, because, the idea of just Nike this, just do it. Now, there is a huge danger in the just do it, because if the IRS wanted to play hardball, they decide to, whoever the new commissioner becomes, decides in litigating cases regarding this to play hardball, you're just in a bad position. Next up, a weird case, but it is something to understand because we're getting to the point with a lot of ERC refunds where clients are either getting tired of waiting or they have received the automated denials that you pretty much look at and know, no. In essence, no, this makes no sense. This client meets all the issues. But as we've talked about before, once you have a denial, there are 2 years to file in the U.S. District Court or Court of Claims, or you just will never be able to get the refund, even if appeals might decide later that, oh, yeah, you were entitled. You can't get it. So we are starting to see more and more cases being filed, not by the promoters, who are trying to get, we've had that come up where various promoters have so far unsuccessfully tried to get the courts to overturn the IRS notice, which, as I've explained before when I've discussed that here, I don't think that would accomplish anything anyway, because the notice, as in the case here in the Phoenix area, the Stentam case, the court simply said, look, bottom line, it's simply the IRS's opinion and litigating position. And while it has a practical impact of huge numbers, it's not, they're going to have some position on this, right? So you need to go to court. But actual cases now that would raise the issue of whether or not these situations qualified as partial suspensions, literally in front of the court now, in real world, and applying the law to the actual situation, and also interpreting whether the IRS position in the revenue in the various notices is correct. So we're there. Well, these are being filed. This case involves a client that simply got tired of waiting. JPM Restaurant LLC versus United States. Now, this is a case number 1:24 CV 00357 from the United States District Court for the Eastern District of Tennessee, and again came out on July the 31st. Now, JPM Restaurant LLC, and you might guess what they do, right? Restaurants. They sought an ERC refund for various quarters from 2020 to 2021 that totaled $338,132.56. So that is high enough, as long as you win, to justify taking the matter to court, right? Because basically the problem is, of course, you need the legal fees and, take care of that. But at $338,000, that one is not one where the legal fees would be greater than the amount you receive if you win. Okay. Now, May 19th of 2023, they filed their ERC claims with the IRS. Okay? They filed in 23. On November 11th of 24, so they waited over a year. They got tired of waiting and said, guys, the attorney counsel told them the way this rule works is, you can keep waiting because the IRS hasn't acted. So the 2-year clock doesn't start running until the IRS issues a denial. The IRS had never issued a denial to JPM Restaurant. So because of that, since there's no denial, the clock wasn't running yet, but obviously the IRS could just sit there and never rule on it. That also is allowed effectively under the law for practical purposes. Yes, there are some people that would try to take to court to challenge it, but most often the problem becomes, well, if you're going to go to court to challenge them waiting that long, then you're already in court. Why not just go and try the whole dang thing, get it done? So that's why effectively I've always said the IRS could just sit on it forever. Now, what happened in that case, so on January 7th of 2025, the IRS Office of Chief Counsel referred the case to the Department of Justice for defense. So now the case leaves the IRS and goes to the DOJ. This is important in this case. It's going to be there. On February 18th, just, basically a month and, a month and a kind of week to 10 days plus after they referred it to the Justice Department, the IRS internally, apparently they were still working the thing internally, they reviewed and approved the request for 5 of the 6 quarters. Now, if you're a taxpayer, you think, great, I'm going to get a check. But then they got notes back saying, sorry, we can't send you the checks because that approval was erroneous. and we're not going to send you the checks. And the JPM Rest going, what are you saying? You're not sending the checks. You analyzed our data in full. You have determined we qualified. Dang, this seems like easy, right? Earlier this year, February this year, you determined that we qualified for this. Now you're telling me, having made that admission, now you're telling me, no, sorry, we aren't the party that can do that. It's got to be somebody else. Now, the taxpayer argued the IRS's unambiguous approval created an absolute obligation for the United States, because again, they're part of the United States government, right, to issue a payment for the approved quarters. And a refusal to do so was arbitrary, capricious, and without any legal justification. However, you're going to find out the court did not agree. And, the court said their motion for summary judgment, Rule 56 of the Federal Rules of Procedure, in that regard, says that's proper only when the party moving, shows no genuine dispute as to any material fact, and that moving party is entitled to judgment as a matter of law. In tax refund cases, the taxpayer bears the burden of proving by a preponderance of evidence that they are entitled to the refund. What the United States Department of Justice, representing the United States, is arguing is that the IRS lacked any authority to approve the claims once the case was referred to the DOJ. Right? That basically there is no ability for them to do it. They had no authority. And the plaintiff, in this case, the restaurant, had not met its burden of proving entitlement to the refund. They're not conceding that the IRS analysis got it right. Now, to be very honest, the IRS analysis almost certainly is going to be part of discovery, I'd expect, and almost certainly going to have the logic of why the IRS says they're qualified. It's going to come before the court. So it's going to be a problem for DOJ. We'll say it that way. It's just like your client, somehow confessing somewhere. It's a problem. But they're saying, but it's still a matter of facts. It's not just conceded. Since they weren't the party allowed to make that call, that does not bind DOJ. If the IRS made the wrong call, DOJ can still move to not issue the refund. So the central legal issue was the IRS's authority to approve tax claims after their case has been referred to DOJ for litigation, which will normally happen at some point after you file your, you file your court case with the district court, because obviously DOJ tries those cases, and the case has to get transferred over to them to prepare for trial and get things going. Now, the IRS said the approval was void because the authority had shifted exclusively to the DOJ, right? Their legal basis for that is under the IRC 26 U.S.C. section 7122, that the Attorney General or their delegate holds the exclusive authority, per the code, to compromise any civil or criminal case arising under the Internal Revenue laws after the case has been referred to the Department of Justice. So the code says, IRS, your authority is gone to compromise, which would include fully settling this case. And that's obviously what the restaurants say. Well, this is a full concession. DOJ is saying they have no power to do so. That's like getting a full concession on this case from your buddy, who is who let's say is a corporal in the Marine Corps, or your son. Well, yeah, he's part of the U.S. government, but he doesn't have the authority to approve this, right? Just merely being part of the government wouldn't make it work. So the IRS, says essentially, so once the IRS has referred their authority to compromise tax liabilities, including basically saying, yep, you're owed this, that ceases. The Internal Revenue Manual reinforces it, stating that once a case is referred, Justice has the exclusive authority to make and approve adjustments to the referred tax liabilities. The IRS employees had no authority to do what they did. Now, the court said, given the January 7th, 2025 referral date, the IRS's subsequent approval on February 18th lacks any legal force. No evidence indicated that the Department of Justice, the Attorney General, had authorized the IRS to settle this case. So even though it seems absurd to you, taxpayer, no, it's not. You probably have some really good evidence to take to trial with you if the Department of Justice decides to go to trial. That's going to be really good evidence to argue to settle the case. But it's not necessarily at this point, conclusive, because just like the evidence from your son, the corporal, it's just not, he's not authorized, right? It doesn't really matter. So because the IRS's approval was without legal force, the restaurant had not met its burden of proving a preponderance of the evidence that it was entitled to a refund. And there was still going to be a dispute to show that that met it. Now, since DOJ can still attack the IRS arguments, that's going to be allowed. The court denied, therefore, the motion for partial summary judgment because they wanted those quarters they'd approved to be taken out of the case. They got judgment for those quarters, and now we're just going to dispute the one quarter that's still open. So it's really important to realize that, this is one of those things that the IRS, once you decide to go to the court. So here's the bad news. And this, by the way, is kind of your risk when you decide to, take them to court after 6 months, more than 6 months. Yes, it would force action. But the problem here is, my best guess would be that just inside the IRS internally, the people processing claims, these ERC claims, they apparently didn't get the notice. So what we now, very likely we now know is, had JPM Restaurants done nothing, not filed suit, and just sat back and let the process run, that all but one quarter would have been paid out, back in February. Because again, and that's what some attorneys will point out, if you sit and wait, because you're going to incur expenses once we go to district court, you can just sit and wait. You would get interest on it, but we have no idea how long it's going to take. So, it's a gamble. You decide at some point, when are you going to be done waiting? But when you decide that, there's always the possibility that you could have gotten the money before the court will rule you should get the money. Okay. So it's helpful to know the risks, and advantages of going to court. Now, if you've had a denial and the IRS is not responding to your request to extend the statute, you don't really have a choice there, right? You just kind of got to go with filing or giving up. But in this case, this is an important nuance of tax practice, especially when we talk about representation work. And yes, CPAs, EAs, generally, unless you are a member of the bar, you're not going to be able to represent clients before the district court, so you really can't represent them in court. But this is part of what you still, if you're in practice, and the AICPA in the Statements on Standards of Tax Services, the recent revision that took effect at the beginning of 24, one of the things they point out, one of the sections added was on representation. These are kinds of details you need to understand about representing clients, so you know what options are there, what possibilities could play out, and what impact they have in order to advise clients when you do representation. In essence, as they say in the standard, it's not enough to just know the ERC inside and out. Once we get to representation issues, you got to understand all of the implications of actions you take in representation modes. So that's kind of interesting how it turned out. Okay, hey, remember, we've had some complete disasters for taxpayers on microcaptive insurance that have gone over recently, because the IRS has been really going after this. But in this case, we're going to this time have somebody who got really close to getting it right. But there's going to be one area where they didn't quite do it right and they lost. But this one, a lot of things, there will be risk shifting here, right? I mean, kind of things that most of the others lose. This one got right, especially risk, properly using the law of large numbers to basically spread out risks. This, in this case, they were found that they didn't. The problem was they were a little too loose with how they administered the insurance policies. And that's where they got in trouble. So this is a case of CFM Insurance Inc. versus Commissioner. Tax Memorandum Decision 2025-83. August 4th was when this one came down. Right. Now, the parties here was Robertino and Antonella Presta, the owners of a chain of Caputo's grocery stores and related entities in Chicago. Right. They formed CFM Insurance under Utah law because Utah law is the most, shall we say, relaxed and helpful for forming these type of entities. So we do see them done in Utah if they're going to be onshore versions. They then 2012 to cover commercial insurance gaps such as product recall and food contamination liability. Now, CFM elected to be treated as a small insurance company under IRC Section 831B. And essentially, what that allows them to do is essentially get out of paying tax on the premiums, right? So the income of that thing becomes effectively tax-free. It's an interesting structure when it works. Okay. Now, CFM collected premiums just shy of $1.2 million annually from their various entities, which all deducted those payments to CFM as insurance payments. Right. Now, the IRS disallowed CFM Section 831B election, asserting it was not an insurance transaction, meaning a federal law, and premiums were taxable to CFM, and they were not deductible to the other companies that that the predecessors held because it wasn't really insurance; it wasn't an ordinary necessary deduction. And they also asserted the IRS did accuracy-related penalties, and that kind of finding is what we've heard in every one of the micro-captive cases we've discussed. But in this case, they got way closer to actually having the IRS lose this case. Why? Well, now the parties had an interesting argument, and one of which was rather unique. Because this was a domestic insurance carrier, and because the insurance was recognized under Utah law, the taxpayers here said, well, the McCarran-Ferguson Act, essentially, which basically makes regulating insurance principally a state-level issue, that Utah's determination that CFM qualifies as an insurance company should be conclusive for federal purposes, right? In essence, the IRS can't question it because they meet the requirements of Utah law. Secondly, they said, even if you're not going to accept that, we're saying that we meet the common law definition of insurance under federal tax law. We have risk shifting, risk distribution, insurable risk, and what we have is a commonly accepted notion of insurance. Now, that second test is the one that's used essentially in all the earlier cases we've had. The McCarran-Ferguson Act theory is brand new in this case. And finally, third, they said, and if they in fact are not an insurance company, then the payment should be recharacterized as capital contributions or deposits for a loss reserve. So that's like, all right. So what we have here is a cascading. The first one, if we're right on that, then everything else goes away. Okay. Well, okay, if we're not right on our first position, then we're going to fall back to the position everybody else has had to argue, and we're going to claim we meet that. But if we don't meet that, so now we've lost 1 and 2, then we're going to say, well, instead of treating this as just non-deductible, income to the insurance company and non-deductible because it wasn't really for insurance to the companies that paid it, we'd like to have this redone as a capital contribution to CFM or a deposit to a loss reserve. In essence, trying to get away with either CFM, trying to get rid so CFM's not paying tax on those premiums. Right, trying to get rid of that double tax problem. If you're in number 3, you're basically already lost in terms of getting the deduction for your companies. So you're just saying you don't want to then have another tax liability here for the other company, which is what makes this really bad. Right? We lose the deduction for these companies, so they spent funds, no deduction. But then the other problem is, but those funds still create taxable income for the other companies. We have created tax out of thin air. That's a bad result. Now, the court's definition of insurance, it said, for federal tax purposes, a transaction must involve risk shifting, risk distribution, an actual insurance risk, and meet the commonly accepted notion of insurance. Those are 4 things. Each one are separate. Risk shifting, risk distribution, actual insurance risk out there, and commonly accepted notions of insurance. Now, the IRS conceded that the transaction satisfied the insurable risk and risk shifting criteria, and the courts will point out why. But that's there, which, by the way, is an interesting concession at trial, but the IRS had to concede that, right? So what they're going to argue is that either there was not actual insurance risk or that these transactions don't meet the commonly accepted notion of insurance. Now, on the Karen-Ferguson Act ruling, because remember, had the court gone along with that theory, this whole case is done and the taxpayer wins. But unfortunately, the court rejected this argument. It said that its interpretation of IRC does not regulate the business of insurance, which is what the McCarran-Ferguson Act banned the feds from doing. We're not regulating insurance. We're imposing tax consequences on what they structured. And nothing says the feds can't tax, a recognized insurance company that's recognized by the state of Utah or California, Arizona, New Jersey, New Mexico, Nebraska, whatever state it might be. They're saying, so no, we're not going to buy the McCarran-Ferguson Act ruling. So sorry, that's not enough that Utah says it's valid insurance. That's fine, can be helpful, but not really going to do anything. So, and they said analysis and finding. We need a sufficiently large collection of independent risk expenditures for the insurers to basically predict the losses reasonably. Now, there is a safe harbor under Revenue Ruling 2002-90 that if a captive insures 12 plus related entities, none greater than 50% of the total, they could meet that requirement. Now, the taxpayer did not argue they could meet Revenue Ruling 2002-90 safe harbor. Okay? So, what the court accepted as independent exposure. So now they're going to dig down and analyze. You didn't meet the safe harbor, but by the way, this is why I said those ERC notices aren't going to govern, because you can fail to meet a safe harbor, and that's what the court looked at those as. In the Stentam case, you can fail to meet a safe harbor, but that doesn't mean, that you're automatically going to lose the case in court. So what the court said was, they said there were 4.5 million annual customer transactions. That's an exposure, right? Across all their stores. They sold 50,000 different products, all of which could lead to issues, right? They had basically from 1,023 to 2,183 employees over the years covered here. Store locations, they had 6 to 8 store locations in the time period. And so insured entities and policies, there were 17 to 19 insured entities and 11 to 14 captive policies. What the court found in that case is, they found that fine, that's enough. The court rejected the IRS's argument to treat all the stores as one entity. They found no legal basis to disregard their separate status, locations, employees, and customers. They found their policies were sufficiently independent. This was not just papering over what was all one big company. No, there were valid reasons, valid business reasons, and they all acted differently. There was no reason to ignore them. The court found a total of 4,551,057 to 4,552,225 independent exposure units, which was over 200 times the exposure units that the court had found sufficient in previous cases the court references. Thus, CFM policies did sufficiently distribute risk. Now, the court pointed out something here before you get too excited. They said this was a startling conclusion influenced by the very unique records. These facts are very unique. And 99% of people that are going to try to set up a microcaptive, the court is going to essentially telling you, would never be able to get close to these facts. So these facts are crucial before you try to take this case and apply it to somebody with 12, with basically what's going to end up being decided to be a total of 12 independent exposure units. You probably better go back and read carefully. The fact it got up to well over 4.5 million, exposure units is not going to be that easy to duplicate anywhere else, right? It's going to be that case, okay? So the court said our fact finding from such peculiar records is unlikely to feed precedents in the future. Now, that's important for you if you're not really a microcaptive expert, but your client gets marketed one, and the marketing company comes in waving this case and saying, hey guys, look, we now know how to win the case, right? We're going to take care of the one flaw they had with CFM. And by doing that, we're going to make this all work. The court's saying you're not likely to get this part of the decision. And if you fail this, you're going to fail. So, watch out for that, because I guarantee you there will be some promoters because, there are legit promoters and there are the people that just try to make a quick buck by, getting something that sounds good enough to sneak it by the advisors for the taxpayer. So the court's put a warning in there for you that you should read. Any promoter comes with that, you need to pull this out and say, look, the court says this is never going to work again. And that's the court you're telling me has this wonderful analysis. They're saying this is not really going to be precedent. Rare will it be precedent. But this looks like a standard marketing copy you're handing to everybody. Can you show me the 4.5 million risks that my client has? Okay. Where the problem becomes is whether what CFM did meets the requirements for a commonly accepted item. What they did was what was commonly accepted to be insurance. Now, some things worked in their favor. They were formal operation. They were formally organized, licensed, and regulated in Utah. That weighed in the taxpayers' favor, right? Premiums were consistently just under the $1.2 million 831B threshold. You can't go above that or you're no longer the small company. As the court said, the fact that every single year these came in at 1.2 million, that weighs against you. That smells bad. CFM failed to consult its own loss history, and that also goes against you. When you're setting premiums, the insurance company should look at its loss history to decide what proper premiums are going forward. However, those premiums were found reasonable due to the commissioner's lack of a counter expert, right? So reasonable is a factor, but those other aspects still weigh against you. So we're not going to say the premium was unreasonable, but the way you went about it was. That's a problem. Collection. This is a big problem. Untimely payment. Often they didn't pay for their insurance for the year until in December. Year-end tax planning time. I'm sure that's not a coincidence. I'm sure that's a total coincidence, right? Yeah, it looked bad. That weighed heavily against CFM. Actual insurance companies do not wait till after the loss period is ended to collect their premiums because they have no real easy way of forcing it. We're going to cancel your policy. Who cares? You didn't pay anything on it, or you paid less than this, so cancel it. I'll give you the money to cover your cover what you paid out, but I'm going to keep the rest of it. So yeah, a real insurance company would never let you get that far before doing it. Ambiguity, the terms and control, and basically there were unclear terms and conflicting exclusions that weighed against CFM. Didn't make sense. It was badly drafted. The claim handling was, per the court, haphazard. Haphazard processing of every single claim, every one of which had material defects. They were paid before notice. They changed the limits in the middle of the claim. Underwriter would overrule the denial, right? It weighs, again, very heavily against CFM, right? Real insurance companies do not have haphazard claim processing, right? They don't pay before they receive notice. They don't have their limits changed, and underwriters don't override the denial of claims processors. And so basically that looks really like it's not. Absentee owners were a big problem. Even though Robertino was supposedly, basically the CEO of these operations, head of the insurance, he had very little knowledge of operations, and he in fact had forgotten he was the president of the operation. Yeah, that seems like the owners, aren't really doing anything. That again is not really what you expect from insurance. And due diligence and adequate feasibility study was performed before the policies were first issued. That weighed in their favor. But the problem were those things that heavily weighed against them. So overall conclusion, despite formal organization, reasonable premiums, CFM failed to operate as a normal insurance company due to significant operational deficiencies. Therefore, CFM was not offering something commonly accepted as insurance. Consequence, it was ineligible for the 831B election. The premiums were taxable income under IRC Section 61 to CFM. Deductions by their entities were disallowed because they weren't for insurance. Therefore, it wasn't an ordinary necessary payment, right? They could not be recharacterized. This is dangerous. Once you've laid out what you say these are, you're not allowed to come back later and then tell us what they aren't. The IRS is allowed to recharacterize them. The only way they're going to overturn that is showing the IRS's recharacterization is unreasonable. Court said, you never intended this to be a capital contribution, right? You didn't intend it to be reserves against losses to be held. That wasn't your intent. You said these were insurance premiums, and if they're not, you're going to have to suffer the consequences of them not being insurance premiums and not being able to try to redo everything retroactively, right? But as far as penalties, they said no, they weren't liable for penalties. They had reasonable cause and good faith reliance on competent advice. Their CPA, Mr. Kwan, right? In essence, they gave him all information. The lack of clear authority on microcaptive insurance at the time that they entered into this also supported this finding as to why it was reasonable to rely on Mr. Kwan and his background, and why Mr. Kwan might have reasonably concluded that this could work. Okay, so it's important to understand that what this shows you for sure is if you operate the insurance operation sloppily, that's probably going to be a loss regardless of how well everything else works. Make sure if you've got this, dot the I's, cross the T's, pay attention, operate it like it's an insurance company. Those are table stakes to have a chance at winning. These guys arguably they got the hard stuff right and fouled up on what should have been the simpler stuff. Right? They just kind of ignored all the other parts of the operation. Make sure that you get the easy stuff right. I mean, it's bad to have gotten the hard stuff right and still end up losing the case. Had they not always had a $1.2 million premium. That gets back to the old line about hogs and pigs, right? In tax practice. In taxes, pigs get fatter, hogs get slaughtered. Yes, this unfortunately went for that 1.2 million max benefit every year. But remember, it's max benefit because you go just above that, then it's suddenly all taxable to the insurance company. Yeah, you probably want to have an actuary help you set the premiums, and it would be nice if they didn't always come at 1.2 million. That you in essence had some years where it didn't get there, especially when you're not really changing the policies. Right? Pay attention to loss history. You need to be doing those things. Hate to say it, but that's part of it, right? You need well-documented, reasonable reliance on qualified tax advisors also is a defense against penalties. So make sure clients know that, if they want to use your view and say that, they want to use you as protection if they get penalized on this transaction, they better have given you everything and they better have listened to your analysis. And if you conclude that it's likely it doesn't work, problem is they can't go opinion shopping. That never works. Okay, next, we're going to have proposed amendments to the fringe benefit rules under Section 132. We're going to switch over to NAICS. What's really funny is it's taken us this long to get here. Okay, this is proposed regs found in Reg 1382805. They were officially published in the Federal Register on August the 6th. The purpose, the Treasury and IRS issued proposed regs to update the determination of employer's line of business for certain fringe benefits exclusions. And these affect the exclusions under 132A1 and 2. That's a no-cost additional services and qualified employee discounts. Now, hopefully you are aware, an employee is taxable if you provide them with a free service. And they have taxable income. They also generally have taxable income if you give them a discount. So, the average customer can buy this product for, let's say, $1,000, but you allow the employee to buy it for $500. By default, both of those are income unless you meet the requirements of 132A1 or 2. Now, for both, the service or property must be offered for sale to customers in the ordinary course of the line of business of the employer in which the employee is performing services, and determining what the line of business is and what employees are considered to be basically being working in that line of business is crucial in designing these programs, right? So the individual receiving the fringe must perform substantial services in that line of business. Now, the proposed regulations were issued under the Secretary's authority found in 132.0 and Section 7805A. You're going to see that mentioned a lot more because obviously after Loper Bright, the IRS is setting up the argument to saying that these have the legislative regulation authority. There's a specific grant by the IRS or by Congress to write rules in this area. Okay. Now, under the regs we've lived with forever, these under Regulation 1.132-4A2I, an employee's line of business is determined by reference to the Enterprise Standard Industrial Classification Manual, ESIC manual. That manual was last updated in 1974. No industries have changed since 74, right? Yeah. Right. An employer under those has more than one line of business if it offers property or services in more than one two-digit code classification. And again, you're looking at a list that was last updated in 1974 to make this call under the current regs. Under the proposed regs, they would replace the ESIC manual, which is no longer being updated, with the North American Industry Classification System, NAICS, which you've probably seen used a lot of times in a lot of places, right? It's the most current classification system, last updated in 2022, and regularly revised every 5 years. So 2027, we expect it to be revised again. This shift addresses many current industries that simply didn't exist in 74. Internet service providers, cell phone manufacturers didn't exist. So now we have whole industries that aren't there. So new classification standards were determined by reference to the NAICS 4-digit industry group classification, right? An employer would be considered to have more than one line of business if it offers property or services in more than one 4-digit NAICS industry group under the new regs. Now, the existing aggregation rules under Regulation 1.132-4A3 would continue to apply with minor modifications now to align them with this instead of the older system. Now, the key amendment to the aggregation rule is to replace, in there they refer to a department store, right? You offer things for sale that would normally, that even though they're from different types of operation, they would normally be offered for sale in a department store. They're now going to replace that with general merchandise stores, including warehouse clubs and supercenters. Why? Because department stores are a rapidly shrinking breed. The old style department stores are in danger right now. Right? You're seeing fewer and fewer. We keep getting more and more announcements of department stores closing locations, shutting down. We've had department stores that have ceased operations. Right? And pretty much every year you're told that, some big remaining department store chain is shutting down a whole bunch more locations. So we're now going to take a look at things like warehouse clubs and supercenters. In essence, the Costco's, the Walmarts, the Sam's Clubs. We're going to use them as a potential classification, right? To aggregate your related. If you're selling stuff, basically, that you could find in a Costco, tires and oranges, right? Theoretically, you could basically be able to aggregate that for a set of employees. So tires and oranges, things like that. Any of the other weird stuff, business supplies and oranges, or business supplies and whatever the heck, patio furniture. Right, a superstore, warehouse club, and a super center that offer those sorts of things. Right? So you're under multiple, and it ensures equitable treatment for employees in modern retail formats, offering a wide variety of merchandise, even if classified under multiple NAICS industry groups. So yeah, so any retail format that would do that, And they've intentionally chosen back, in 74 when we had the prior standard. A department store was the sort of thing that sold the biggest variety of products. Now they're saying that's not really right now. Now we're looking at like I said, the Costco's and the Walmarts as being the ones that sell the widest variety of items, things like that. And it's a physical place you go see, they sell them all in one place, because obviously you can say, what about the Amazons? Well, the Amazons get pretty close to, shall we say, the warehouse clubs and supercenters. What they stock is pretty much the same. But, basically understanding that, yeah, we're going for a new, broader category. And they had changes to two examples takes into account. So they said an employee operates delicatessen, which is a specialty food store, and an attached service counter or restaurant. Right? If most employees work at both, these separate operations are treated as one line of business for fringe benefit purposes. And retail operates on the same premises. An employer sells both specialty foods and small kitchen appliances on the same premises. If these types of merchandise were not for sale together at a general merchandise store would be considered one line of business, then these operations can be treated as one line of business for the employer. Now, this is only a status proposed rulemaking, and it does not contain what we often see, where taxpayers may rely on these regulations prior to being done. Right? They're proposed to be effective on the date they are published in Federal Registers as final regulations, and they would apply to taxpayers beginning on and after that date. Now, Treasury has issued comment requests for these regulations, right? Basically making the transfers. You can check the regs for that information. Right now, your key goal is to stay up to date on that. And if you have clients that offer these sorts of programs, you might start looking at, will this change impact them, and how would it impact them? Let's start talking about pass-through losses in bankruptcy. Field Attorney Advice 2025 53101. Okay. So this field advice 2025 3101F issued on August 1st of this year. This addresses two critical issues involving net operating loss carryback. This was a carryback from a year where that could happen by individual taxpayers who are shares of an S corporation undergoing a Chapter 7 bankruptcy. Now, the situation. A married couple filed joint returns, claimed a $6.9 million NOL in their 2021 taxable year, primarily from S Corporation, right? The S Corp utilized a fiscal year ending September 30, filed Chapter 11 bankruptcy in 2021. It was later converted to Chapter 7. Now, the taxpayers deducted non-passive losses from FSH S Corp under 2021 Form 1040 and then filed a Form 1045 to carry that loss back. Now, the concern that the IRS, because again, this is an internal document, and the concern that area counsel had with this claim was that would the taxpayer receive a double benefit from the NOL carryback in addition to a bankruptcy discharge of the S Corporation's debts? And secondly, does the ongoing bankruptcy proceeding of the S Corporation impact the release of funds to the taxpayer? Can the IRS hold on to those funds pending the resolution of the bankruptcy? The key finding, the field advice clarified there is no double benefit, right? Because the taxpayers erroneously, they said, well, one big problem is they erroneously claim the FS Corp loss under 2021 Form 1040. So bottom line, there was kind of like a big error to start with, right? Basically, what they tried to do on their 1040 was claim a loss that would not show up until basically the S Corp return that would issue its K1 in 2022 in September 22 year end. They tried to claim, because apparently whatever happened, it was a big problem that occurred in the last quarter of 21. Yeah, they said they can't claim that loss yet. Look, they just got the wrong year. They can't go back and put that on the return, right? So what happened there was, the S Corp used a fiscal tax year of September 30. The pass-through items from the fiscal year ending September 30, 21 would flow through 21, 1040, and September 30, 22, which is where the big loss will come from. That would go on the 22 return. It doesn't matter if the big loss occurred in the last quarter of 21, so let's say, October, November, December, their fiscal year, you defer the income. That's probably why they did it, right? Again, now with the weird problems you have with S Corp, fiscal year S Corps, it's I'm not sure it ever works well, but sometimes theoretically it could. The problem is you're definitely going to defer losses too. There's a big loss, you're going to delay picking that up. And that's what they ended up doing. So they said they got to do that. So because that loss from the S Corps fiscal year beginning September 30, 2022 on a 2021 1040, and that's an easy error for people to make because, of course, the 1040 will say 2021. Because you use the year, the date, the form year at the top, the big number is the date the year started. But for this purpose, in this fiscal year, the year ended 22 would be when the calendar year taxpayer would pick up that K1 on the return. So, these losses cannot be added to the NOL for 21. This mismatch means that their NOL for 21 was overstated, and therefore, obviously, you adjusted for that. So saying first thing is you miss an obvious thing that has nothing to do with the bankruptcy. We're there. Now, other finding was that the ongoing FS bankruptcy does not affect the taxpayer's ability to claim a pass-through NOL from the entity. So had they done it right, had they really done the right year, had this loss been on the 21, they would have been able to still claim the NOL. That wasn't the problem. Nor does it prohibit the IRS from releasing the refund money to them, right? First thing is there is no corporate discharge in the bankruptcy. And Bankruptcy Code 727A1, Chapter 7 discharge is expressly only for individuals, right? Corporations may not discharge their debts in a 7 liquidation proceeding. There just won't be a corporation there. They are disappearing. Individuals don't disappear, right? It's not, it's not like it's like, no. They're still living, breathing, and exist afterwards. So they're the ones that get a discharge. In the Chapter 7 proceeding, the creditors are just left with nothing there. So, there's not really any discharge. Now, there may be cancellation of debt, but that's a separate issue, right? And that's dealt with by Section 108 and all the various rules there for when you don't recognize that income and what you have to do to recover attributes. And it may be that when the NOL can go back, that, people will benefit from that. That's kind of what 108 was designed for. And S Corp losses are not property of the bankruptcy estate. Under IRC Section 1363 and 1366, S corporations are not subject to federal income taxation generally, and their losses flow directly through to their shareholders. Therefore, the NOLs and any resulting federal income tax refunds are property and rights of the individual taxpayers and not the S corporation's bankruptcy estate. So if there had been a loss that they had basically fouled up using the wrong year's K1, they would have been able to carry loss back. You weren't right with your initial theory, in this case. And they reference here the case of Morad versus Commission from 2003. There, the S corporation bankruptcy petition did not terminate its status as an S corporation. So given that the S corp will not receive a discharge, and its losses are not property of the bankruptcy estate, there are no concern regarding any double benefits to the taxpayers or the S corp stemming from the bankruptcy case, right? So key recommendations and takeaways. Number one, if you got fiscal year S corps, please remember fiscal year anything that's a K1. Remember, you need to check to see when the year ended, not when the year began. Make sure you get them on the right years. This is an easy mistake for somebody brand new to taxes to make. They see that big, 2024 on the K1 and don't notice what was for a fiscal year ended, March 31st, 25. That won't go on the 21 calendar year return of the person holding the interest. But, so double check that. Remember that, right? So because of that, they said, you had to omit those losses, we said. But like they said, because the bankruptcy procedure does not affect any sort of refund to the taxpayer. Had there been a refund, they still get it. We don't have to hold it there, right? So it wouldn't affect it. So what they're saying is, first thing is attorney writing us, take a careful look at what's in front of you. there's a huge issue that will take this whole thing off the table just by noting it. But even if it had, it wouldn't by itself have caused a problem. Next up, we had an OPR issued one of their alerts this week, and it discussed about proactively engaging with OPR when it turns out you believe you may have violated Circular 230. And the title of this email, if you subscribe to these, I suggest you do. It's nice to see what they're talking about. It says, fessing up can be in your own best interest, self-reporting a practitioner misconduct. This is an alert from the Office of Professional Responsibility, issue 2015-2012. I like it's 2025. I think it's a typo. August 6/25. Now, the Office of Professional Responsibility administers and enforces Circular 230. That officially, regulations governing practice for the Internal Revenue Service is what Circular 230 is. That's what's entitled. It set rules for attorneys, CPAs, enrolled agents, and the like representing taxpayers before the IRS. Circular 230 aligns with fundamental principles of professional practice, including diligence, competence, promptness, informing clients of errors and omissions on government submissions, and avoiding conflicts of interest. So it kind of discusses the general purpose of Circular 230. There are various sanctions that the OPR can impose if you violate them. Violations, especially willful, reckless, or gross incompetence, can lead to censures, suspension, disbarment, or monetary penalty. So if you discover you got a problem, you may be facing some very nasty consequences with OPR. Now, disreputable conduct under Circular 230 includes any federal or state felony conviction and any disbarment or suspension by a state licensing authority. So you need to worry about those, right? Now, they said OPR discovery. How do they find out you've done these things? Well, they routinely hear misconduct through internal sources, revenue agent referrals for noncompliance, and external channels, research on past convictions, state bar and accountancy board actions, media reports, and client complaints filed via Form 14157, where a client can complain about you, right? They're saying. Now, they do point out something important here. Many attorneys and CPAs typically are required to report convictions, misconduct finding by government entities, civil judgments, court-imposed sanctions, or other adverse actions to the respective state bar, board of accountancy, or other licensing authority. That is absolutely true here in Arizona. Like I said, I was teaching ethics on Friday, and we talked specifically about that little issue, right? So, for examples, though, from other states, North Carolina, that are cited in the notice, North Carolina CPAs must report criminal convictions, judgments for professional negligence, and IRS inquiries and liens. Florida licensees must report convictions and guilty pleas for any crime that was related to their practice. And ABA Model Rule 8.3a imposes an obligation on attorneys to report serious misconduct by other attorneys. It's interesting. Yes, you have to rat out the others, shall we say. But Circular 230 itself does not impose any explicit self-reporting requirements on practitioners. I'm going to stop here for just a second. Under most state CPA rules, when I'm most familiar with that, being a licensed CPA, failure to make that report of the fact that you were disciplined by, let's say, the OPR, that is in itself a new violation of the requirements under the state statutes in most cases, or at least the regulations of the state board. So that's its own actionable case against you. Now, OPR does not have that rule. So the fact you don't tell OPR does not give them another factor, another thing to accuse you of violating, right? Now, there are some implicit requirements that lead to reporting. On the PTM application on Form W-12, you're asked about past felony convictions for new or renewing applicants. Obviously, perjury there is a problem, and you'd be charged with that. So you're supposed to, basically report. And EA or ERPA renewals under Form 8554 asks about criminal convictions or civil discipline. And again, lying on your renewal form, if you're an EA, is a bad thing. Lying on your renewal form, if you're a CPA in Arizona, is a chargeable thing by the board. And I'm pretty sure lying to the bar is not, lying basically to the Supreme Court of your state, who licenses you if you're an attorney, That's also a bad thing, shall we say. Basically, could get you in big trouble on its own, ignoring everything else. Okay. Now, why then would you self-report to OPR? Because unlike the Arizona Board of Accountancy, which requires me to self-report certain things, the federal law doesn't require me to tell OPR, they got to find it. Well, they said first problem is, and this is one is why you should talk with counsel, and it comes up, is OPR will know. Well, okay, there is a chance they won't, but there is a real good chance they will. Now, OPR states will virtually always be notified of matters rising to the level of professional discipline by licensing agency. That's true. Most state boards of accountancy would notify the OPR, or if nothing else, would publish actions, their public notices, right? So all OPR has got to do is check 50, whatever. Well, we got a few extra because we have the territories. So let's see, probably 54 licensing jurisdictions, 55. That, so if they check all of those, right, they'll probably can find out whoever got disciplined. And if they're a CPA that got disciplined, especially as for a tax-related item, then yeah, OPR will probably find out about it. And generally, it is better if they learn from you than if they learn from a third party. But as I said at the start of this broadcast, this is written by the enforcing agency. Every enforcing agency, every law enforcement person would always tell you, oh, just come confess everything to us, everything will be fine. If you talk to most attorneys, they will tell you that you really shouldn't take them at that word because those parties have a huge conflict of interest. Right? Makes it way easier for them if you confess. But that doesn't mean you shouldn't. But it does mean that you better consider things beyond just, the enforcing agency is saying, hey, it'd be great if you'd confess. It's like one of those things, where you see that it'd be great if you'd confess to this. Sounds great. But if you ask them, especially if they're representing our collective bargaining agreement, so if you end up committing something that could negatively reflect on you, might require discipline, but you're not required to report it, would your union rep suggest that you go ahead and confess it? Just right away? Or if you'd consider, right, yeah, that's the difference. I only phrase it that way because my brother was in law enforcement forever, and I say, yeah, I mean that's great, but you and I both know that your union rep would tell you not to do it if there was some potential malfeasance by you. Not that you've done any, but you know they're going to back that. It's kind of the way it works, right? So again, be sure, right? OPR will request makes sense. If you get in early, and this probably is true, much easier terrain for concurrent sanctions. The problem with getting OPR discovering late is you might have got an agreement with the State Board of Accountancy that you're going to be disciplined and suspended for 2 years, but you never told OPR. And it's a violation for OPR. And maybe you didn't tell OPR because you're also licensed as an EA. So I don't really need to be a CPA, to do representation work. I'll just represent on my EA certificate. Great, but you still are disciplined, and that's still a problem. But as a CPA for tax issues, the problem is if the OPR does not discover it quickly, but does discover it, they're going to go through their processes, and they might impose a separate suspension period, which in the worst case could start essentially right after you lose the first one. Remember, OPR would not just suspend you from being an EA. They would suspend you from practice, which would mean getting your CPA license back won't help you. So yeah, that would be a problem. It avoids an extended or deferred OPR action. If OPR learns of a state suspension much later, its action might begin well after the state suspension, potentially leading to a new, separate, and probably longer circular 230 suspension. Okay. And generally, this, of course, is what the enforcing agency will always say, and it's not wrong. But please remember that you can't hold them. This is not a promise. OPR is authorized to consider all relevant facts and circumstances, self-reporting and cooperating, providing information are considered relevant facts. The theory is you'll get off easier if you confess. That is likely true, but not always true, especially if somebody else did it first, right? Or if you go in and confess not knowing that they already have the information. They hadn't gotten around to sending you a letter yet, but yeah, if you do that and they discover you confessed, it might not be helpful. And as the complaint was already going to go out, you just kind of came in and confessed, and so you got rid of your defense. So yeah, we're there. There is an opportunity for a deferred discipline agreement. They note that they are used by OPR, right? Practitioners act responsibly and express genuine intent to reform behavior. This can defer immediate sanction for a probationary period. In essence, we are more likely to give you probation. That is probably true. Now, again, more likely doesn't mean will. This is what your counsel will tell you. More likely doesn't mean they will do it. It just means it's more likely. So, you have to consider how to come in. That's also why having counsel is helpful, because they can actually start broaching questions with OPR without having to actually disclose who they're representing. In essence, the fact that they have privilege can help them negotiate for you, because OPR is going to have to make commitments, not just these vague promises ahead of time. But yeah, it could help you negotiate. And what I'd say probably makes the most sense is check with counsel, and then counsel, and you can decide if it's going to make the most sense to approach OPR. Very likely may decide it is, because it'll definitely get, if nothing else, a big question that's going to be over you constantly from going would make that go away faster. But then probably will approach initially in a kind of, I'm making contact on behalf of somebody who is thinking of coming forward. I need to talk with you about what the consequences will be if they do. Things of that sort. And they have and they do have authority to accept a petitioner's offer of consent to be sanctioned through settlement negotiations. So it is a matter of negotiations. That's probably why I say consider this. Don't reject it entirely. And certainly, basically, always get counsel. Dang, it is your whole livelihood on the line here. Get counsel. And don't try to do it on your own and stonewall it. That might work, but it's going to go really bad if it doesn't. You'd be much better off having legal counsel involved to help you through this, right? So as they would say, proactive engagement, your best interest, the marketing from OPR. Please remember it's marketing. Please remember, consult counsel. But, if you as a Circuit 230 practitioner encounter a situation could lead to professional discipline by a licensing agency or involves a civil or criminal sanctions or tax penalties, do not summarily rule out self-appointed OPR. And I think that sentence as phrased is correct. Don't rule out. No, we didn't say go do it. We just said don't rule it out. You need to have a discussion, open discussion, and make a decision. And do remember, one problem you are facing is if you are going to self-report, the clock is running. Right? Once OPR discovers it on its own, then it may appear that your confession is essentially, you waited to see if they get it, and then you decided to try confessing. It's like, yeah, you were hoping you could stonewall it. That's the impression that can be given. And as we said, and this is something which counsel will go over with you. Look, if this is something they're absolutely going to find out about anyway, we're going to try to figure out a way to broach the topic with them, most likely, as opposed to wait. The only reason to wait if they're going to find out anyway is if it doesn't matter. What you did is so awful and so horrible and so terrible that you're going to get the book thrown at you no matter what. Which case then, yeah, it doesn't really do anything. You'll be looking at different ideas. Evaluate timing. Like we said, inter-engagement offers the best chance for concurrent or synchronized resolution. That is something that will be considered. If you're going to be going before the state board on a tax matter, you should consider whether it makes sense at this point to open up and tell OPR that this thing is running or not. As I said, one of those things. And as I said, consider, doesn't, and please do not take that as due, but consider informing OPR if you've committed sanctionable misconduct, especially if you've already been sanctioned by another authority. That latter part makes it more likely you want to contact them, but be aware of that, right? Okay. They also suggest in this newsletter, I'm just summarizing what they told you in the newsletter. Again, please remember who wrote it. Accept responsibility and show reform. That's going to be important for almost everything. When I was teaching Friday on Arizona's ethics rules, yeah, that is something the State Board of Accountancy considers when deciding whether to let somebody for whom they have revoked a certificate potentially become a CPA again, is have you shown reform? Basically, are you sorry for what you did? Have you shown that? That is a thing that will be considered. You've got to say, you can't just say, look, I did my time. I don't think I did anything wrong. Is probably not going to help you. Okay, in essence, you're going to get a worse settlement. That's going to be here. And you're probably going to be basically disbarred for good. So be aware of that. Make sure you have the mitigating evidence. So persuasive mitigating evidence. Cooperation we take into account as potentially a mitigating factor, but again, potentially doesn't mean it will be, doesn't mean there'll be any mitigation allowed. So be aware of that. And they said potentially you can mitigate severity and duration of disciplinary actions by engaging. And as I said, my point in bringing this up is not to say just go blindly follow what they said. My point is to say there is some merit in engaging, as long as you do so having counsel, right? OPR is not necessarily out to get you, but they're not on your side. I'll phrase it that way. Their job is to represent the public interest, right? They're not supposed to cozy up to CPAs and EAs and attorneys, right? That's conceptually how it's supposed to happen. So, remember where they come from. Finally, we'll talk about this, and then we're going to close off this thing. The IRS announces a policy for the One Big Beautiful Bill Act for 2025 for payroll issues. Bingo. This is a news release, 2025-82, issued by the IRS on the 7th of August. Right. The IRS issued this ruling. It says it has its phased implementation strategy for the One Big Beautiful Bill Act related to payroll matters. And the key takeaway is that for tax year 2025, the IRS has decided to maintain the status quo for information returns, 1099s, W-2s, and withholding tables. So we're not going to have a radically different W-2, a radically different 1099. We're going to have the same as we have now. So unchanged for 25 per this IRS announcement was Form W-2, the existing 1099s, the drafts they have now, they don't plan to add additional new drafts with different changes, and Form 941 and other payroll tax returns. Right? Withholding tables will be unchanged for 2025. They are going to, and they're supposed to update them for 26. Now, that bullet, let's stop on for a second. That does not mean an employee or your client cannot calculate the benefit of OBBBA things. Maybe they're going to qualify for the tips subtraction. They're going to qualify for the overtime subtraction. And how much, and you can help them work up how much that's going to affect this year's taxes. You can go back in and file a new W-4 and modify what's being withheld. So that's there. But the rationale for no changes per the IRS is to prevent disruption during the upcoming tax filing season and provide ample time for the IRS, businesses, and tax professionals to effectively implement future changes. Now, not sure if the timing of this got involved in, because the problem is, and I think one of the problems with what the commissioner said, and, with other announcements, obviously there are going to be, when the IRS has a reduction in force to 25%, was that really getting rid of the fat? Or did that actually trim out things that are needed? And, so some might take this to say, well, look, they just don't have the staff to do it. And that would be a negative. And that's probably not a good thing to do negatives and saying, okay, first passing the big tax bill and cutting IRS staff. Well, those two, you might argue weren't compatible if you weren't cutting fat. So that's why I think the timing of this could also have had an issue there. We'll see what goes on. Or he just likes Ireland. I don't know, whichever. But I would have thought Ireland existed for a long time before he decided to, accept the nomination for. So I'm thinking that Ireland didn't change. I'm just thinking that maybe, something else changed. That's, again, I'm cynical that way, but so much. Operational guidance for 25. Employer and payroll tax providers are instructed to continue utilizing their current procedures. So you can get the information about doing this online. Nothing has changed. We are anticipating changes for 26, right? The IRS will have new guidance and updated forms for year 26. And the forthcoming updates are expected to include changes how tips and overtime pay are reported. Yep, given they're going to be reporting changes. So look for all of that. So yes, if you're in payroll, good news, nothing changes right now. Bad news, in less than 6 months, we're going to start seeing changes. And by the way, on the law change, what is qualified overtime is going to be a very complicated thing for your payroll department to determine, because it's not just what they currently call overtime. Or in fact, what they currently call overtime probably includes things that won't qualify for this. So that's going to be a messier one to deal with. The IRS has indicated its intent to collaborate closely with employers, payroll providers, and tax professionals on these things. So basically, they're going to be making comments. They're going to be reaching out on these areas. We'll see how things go. As we talked about, remember to start this, we talked about we needed 174A guidance now. There's a lot of things that need guidance. But this is one they do face an order to get the withholding tables updated by the beginning of 26, and to, they need to release that other guidance because payroll departments had to figure out how to do these things. So we have all of these things going on. So benefits, individual taxpayers, the IRS plans to produce additional information in the coming months about how they can claim their related tax benefits when they file the return. I would say the IRS almost certainly not broach the issue of you could modify your W-4 right now. First thing is they don't want to be blamed for people that end up owing tax, right? That would be bad. And yeah, it's just simpler not to go there. But remember, for your clients who are concerned that their taxes will be lower, they know it now. We have this. So you can go ahead and adjust those withholdings. You don't have to wait for the IRS to issue updated withholding tables. Both Treasury and IRS are in the process of preparing additional guidance, for reporting entities, taxpayers alike. These are found on the IRS website, etc. The IRS is supposed to give us some sort of safe harbor for computing overtime and tips for this year, because we're still required to provide some information to our employees about those things. And the employee's got to take some positions on their tax returns, so we got to figure out how to make that work. But the IRS right now is saying they're going to emphasize stability and continuity for employers and payroll providers. And seriously, I don't really expect it would have been different even if the IRS had not lost a single person and they'd upped their numbers of people by 25%. I still think they probably wouldn't have touched this, right? So I don't really think this was caused by a reduction in force. I think this is a pretty normal way for the service to approach this, but it's timing with the other things happening. There were a couple of other incidents I became aware of that just kind of seemed like the commissioner might not have been on topic or on point with the messaging that, basically Treasury wanted. So, yeah, I just think the timing of this release could have been a problem, because as of Friday, he wished all the IRS employees a wonderful weekend to be ready for Monday, right? Actually allowed them to get time off early, etc. And he had a whole thing about what he's going to be doing next week. So it's like this whole idea of him leaving came up very quickly, shall we say, right? So again, remain attentive to these changes. Warn your clients who are business clients about the needs they're going to have to change and have to modify their payroll procedures. Because I don't care you use paychecks. Paychecks won't really be able to easily know if you are paying FLPA overtime or overtime for some other reason. Yeah, you got to do most of the identification work there as to what counts, what doesn't, and make sure that, let's say, if like under state law you have to pay it, because my understanding is California says if in a day you work more than 8 hours, so if you had an employee work 10 hours on Monday, right, and then do 6 hours on Friday, they still have 2 hours of overtime under a day-based 8-hour test. But since they had 40 hours for the week, they wouldn't have an FL, basically Fair Labor Practices Act, federal overtime requirement. So you got to watch for that. Well, this has been the update for the week of August 11th. Again, you can email me if you have questions, edzollers@currentfederaltaxdevelopments.com. There, I also do participate on the Connect sites for Arizona, New Jersey, Idaho, Illinois, Minnesota, right? Got all those. Washington, yes. Okay, got everybody in there. So you get me there. Otherwise, we're going to go ahead, see what happens in the coming weeks, in the coming week to see what comes up with this week. Probably won't get a new commissioner name for a while, so we'll have to watch for that. And see if the Treasury Secretary makes any changes while he is acting commissioner. That's also something to watch. But otherwise, we will see you guys next week for more current federal tax developments.